Looking specifically at Kmp, you can see $5.7 billion of expected earnings before DD&A. Natural gas pipelines as a result of the El Paso acquisition and the drop-downs that came from KMI to KMP, and a result of the Copano acquisition is now over 40% of KMP. Then CO2 is about 25%. If you break that 25% into what is the oil production versus what is the traditional CO2 pipeline business, about 18% of our business is associated with the oil production. This is really the only place at KMP where we have direct commodity exposure. And so we're very focused on hedging that commodity exposure. And you can see on the right-hand side of the screen that 2013 we've got about 80% of that hedged. And our sensitivity to a dollar move in the price of oil is around $6 million in DCF. The terminals business is about 15%. Canada is about 3%, and products pipeline is about 14%. So you can see a big move if you look in prior years versus the current year towards natural gas as a result of the acquisitions. This is our 2013 growth budget. As Brian mentioned, when you look at it with acquisitions, so including the Copano acquisition, about $10 billion in acquisitions and expansion. If you look at it without acquisitions, it's $2.8 billion. Now, the comparable budget number is about $2.5 billion. So we've got about $300 million of incremental spending above our budget, which is primarily a result of new opportunities that we've identified since the time we did our budget. There is some spending that moved from 2012 to 2013, but the primary thing driving that $300 million is just additional opportunities that we've identified since the time we put our budget together. The other thing I'd mention is that all the expansion capital associated with the acquisitions is in the $10 billion number, not in the 2.8. So the spending associated with Copano and the spending associated with the drops, the 50% of EP&G and the 50% of midstream. So over the last 16 years, we've invested about $40 billion in capital at KMP. Obviously, you can see the largest year is what we expect to do in 2013 of $10 billion. But we've invested about $18 billion in expansions and about $22 billion in acquisitions. So a little bit more in acquisitions than expansions. And as you can see, and as our pie chart previously indicated, $22 billion of that has gone into natural gas pipelines, and then products, terminals, and CO2 all at about a little over $5 billion each, and with Kinder Morgan Canada being the smallest. So how have we done on investing that capital? We have generated, as you can see, a KMP ROI, so that's an unlevered return on that investment of about 13.6%. And we think about our cost of capital being about 9%, so that's about 460 basis points over our cost of capital. And that is one of the largest drivers of the growth in cash flow that I mentioned. We do not do projects close to our cost of capital. So, we're not going to go, our cost of capital is 9%. We're not going to go out and do a project at 9.5% or 10% because there are just too many potential for changes in what you expect to happen and what actually happens that can result in that project not being as good. Now, it could be much better, but we're not going to take the risk that we have a project come in at or below our cost of capital. So we generally think that we need to earn at least about 300 basis points above our cost of capital. And then beyond that, what we do is we look at the risk of the project. And so if we have a 20-year take-or-pay contract on a natural gas pipeline where we're not taking a lot of risk on construction, then we expect to get a 12% return on that. On the other hand, at the other end of the spectrum, if we're investing in a CO2 flood where we're actually using our CO2, injecting it into the ground and producing oil, and so we have some commodity risk and a little bit more volume risk, then we're going to expect to earn a 20% unlevered return on that investment. And you can see that theme playing through as you look at the various segments. So natural gas pipelines, we earn about almost 12% return on our investment, as well as products pipelines, versus you look at CO2 in 2012, about 29%.